Hello, hello, and welcome to the third of a series of conversations focusing on the challenges that leaders face in these extraordinary times. I'm joined this afternoon by three of my colleagues from Oxford Saïd's finance faculty, all of them with very distinct lenses on the challenges facing our economies and our financial institutions as a result of the Covid-19 pandemic. So as governments around the world are pouring billions into supporting companies and citizens, and as we all face such an uncertain employment future, we're going to spend the next hour examining some of the shifts we're likely to see in the financial system, and also asking how this crisis might rebalance the relationship between the firm and the state. And we'll explore the economic impact of lockdown restrictions and how countries and companies are going to seek to mitigate the effects in the long term of this pandemic. Well, I'm joined, I'm pleased to say, by three of my colleagues, Alan Morrison, who is a professor of law and finance and whose research interests cover banking, the investment banking sector, regulation, and corporate governance. And he also teaches business ethics on our MBA and executive MBA programs. Bige Karaman Alpa has also joined us. She's an associate professor of finance here at the school, and her research interests are in the asset management area and in market volatility. And Dimitri Simokos is professor of financial economics here at Oxford. He has also led our masters in financial economics at the school, and his research has impacted economic policy around the world. He's worked with central banks on researching banking regulation and systemic risk. And he was an advisor during the economic crisis, during this eurozone crisis, to the Greek government. So we have a lot of expertise here, but I hope that as the conversation continues, those of you who've joined us will also put your questions into the Q&A section, and we will seek to answer them as we go through our discussion. So, Alan, I just want to start with you and ask you how much we should compare this crisis to the financial crisis of 2008, which all of us remember. How reasonable is it to do that? And can you sort of paint me a picture of how you see our current situation?
Well, there are some similarities, obviously, in that we had a significant economic shock in 2008 and 9, and the coronavirus has also had a profound effect upon our economic well-being. So, for example, one of the food banks near my home has seen a 37% increase in its custom. UK unemployment is higher than it's been for 30 years. And in a report published only a couple of hours ago, the Office for Budget Responsibility says that the UK's GDP could fall by as much as 35% in the second quarter of this year. Survey evidence indicates that 15% of our workforce is planning to claim in-work benefits as a result of the coronavirus. And our experience is being replicated around the world. More than 16 million people made unemployment claims in the United States in the last 3 weeks. And according to the International Labour Organization, 81% of the global workforce have had their workplaces fully or partially closed. And absent coordinated action, the impact of the current health crisis on the poorest people in the world, who often live in extremely close proximity and who have almost no financial reserves, is going to be profound. The United Nations survey last week claimed that poverty levels in developing countries could be set back by 30 years. So it's hard to make predictions about how this is all going to pan out now, but we could face the worst economic contraction we've seen in a century. So insofar as the coronavirus crisis is affecting everyone economically, it's certainly a systemic phenomenon. But it's not obviously a financial crisis in the sense that the one we experienced in 2008 and 9 was, because that economic slowdown had its genesis in the financial sector, and largely as a result of the reforms that were introduced when the dust settled on that episode, banks are far healthier today than they were a decade and a half ago. In fact, banks have already survived widespread drawdowns on credit lines that might have finished them off in 2008. So there are differences, important differences. I think it's worth just briefly making 3 points about the roles of banks in today's crisis before I stop. The first is that today's economic slowdown was precipitated by a decision to hibernate the economy in response to a serious public health crisis. whereas banks were arguably one of the sources of 2008's problems.
Hello and welcome to the third of a series of conversations focusing on the challenges that leaders face in these extraordinary... I think we have a little bit of interruption in the background there, Alan, but...
I was simply going to remark that banks were arguably one of the sources of 2008's problems, and today they have a different role. They probably have a very positive role to play as we address our economic challenges. Governments around the world have allocated about $8 trillion of fiscal support to the economy, so we can restart and experience a so-called V-shaped recession. Banks are probably the most important channels through which support is going to reach its intended targets. Second, as the gatekeepers for government support in most countries, banks have to navigate serious reputational risks as they allocate that support. State support obviously shouldn't bail out bad businesses and unsuccessful speculators, but right now it's better to err by advancing funds than not doing so. Nevertheless, at least in this country, smaller firms appear to be finding it hard to access coronavirus business interruption loans. Yesterday's FT reported that some corporations have been denied access to funds for lack of a prior borrowing relationship. And today's FT claims that banks are imposing very hard conditions for access to loans. So acting in support of the policy objectives of state-sponsored lending programs can probably help banks to resolve the crisis of legitimacy they experienced after the 2008 financial crisis, but failing to do so appropriately is going to cause reputational damage if it happens. And precisely because banks are being called upon to make judgment calls, their own governance is going increasingly to be placed under the spotlight. They have not only the opportunity to demonstrate their social utility in incredibly challenging situations, they've also got the opportunity to behave irresponsibly. European and UK banks have largely suspended dividend payments and paused share buyback schemes. There is a very strong argument that they should think about how they pay their senior executives at these times. Okay, the final very brief remark I'll make is that the decision to hibernate the economy would cause wholesale bank failure if it weren't accompanied by large-scale government support. And even with that support, banks cannot play their part if they don't assume some risks. They're lending at low interest rates in the face of immense economic uncertainty. And there is a risk that the effects of the public health emergency upon the business world could serve ultimately to harm the banking sector, even with its currently enhanced capital and liquidity buffers. And the real danger is if that happens, that we might see the sort of credit crunch that characterized the 2008-2009 financial crisis. And in that case, our chances of emerging rapidly from our current hibernation would be very small indeed. So I'll just conclude by remarking that although I don't think we currently face a systemic financial crisis, we should be incredibly alert to the possibility that one could emerge. I'll stop there.
So there's a huge amount there, and I know that some of our audience will want to come in with questions about that, and we'll want to delve into some of that area for discussion. But very interesting to put that lens on the difference between the financial crisis and the kind of systemic crisis that we're facing now. So Bige, I just want to move to you now and look at the area that you research, which is very much around market volatility and how the markets react. We've seen huge volatility in the markets, but what does that mean for us in the sort of medium to long term? And, you know, how should investors be reacting? How should we as ordinary members of the public, as sort of savers and people with pensions be worrying about this?
First of all, thank you all very much for organizing this. It's a great opportunity to be able to do this and connect with the wider Oxford community as well as the public. Like Katie mentioned in the beginning, so I welcome all the participants to participate in this discussion and make it more interesting with their questions. So please do not refrain from participating through the chat box. So going back to Katie's question, so it's true, there has been a huge volatility that we have observed in the recent month. Actually, the levels of volatility are almost like comparable to what we have seen during the dramatic 2008 crisis that we experienced previously, or even maybe the Great Depression. So the natural question for a lot of market participants is that, like, what is really going on? What is generating all this price volatility? So in these kind of times, the turbulent times, there are multiple things are happening all at the same time. So it is difficult to disentangle each individual component and make very precise statements. But nevertheless, to put this in perspective, we can still identify the most important things that has an important impact on price volatility. So number one is, as Ellen also mentioned before, this is a major shock that affected many businesses in a fundamental way. So basically, I mean, this is a fundamental shock, and of course, then the markets are going to price it. Right? For a lot of companies, there's a severe negative demand shock. Also, for some, there's also a supply shock, so which directly impacts their fundamentals, their earnings, and of course, the market is pricing it. But on top of that, there are also other things that are happening, which is perhaps a little bit more puzzling and requires more articulation on. So one thing that we may have observed is that there are certain assets that are relatively safer than the others. So there has been a COVID shock, of course, affected many sectors, but there are certain assets like US treasuries or some precious metals, say like gold, or even some tech companies, right, which have relatively strong fundamentals like Google. If you look at the prices of those, you may find it surprising that even those assets have experienced a dramatic drop. So I think a lot of people are puzzled, right? And they're trying to understand, they're trying to make sense of it. And generally people, when they can't find an obvious answer to something when it comes to financial markets, the temptation is to try to explain everything through a panic behavior. So then it's worth thinking about this hypothesis, right, a little bit more carefully. Is it possible that the panic-driven trades are generating this huge amount of volatility we're observing in the markets? So I think it's hard to reject the hypothesis that the panic doesn't play any role. It definitely plays some role, but we also know that it cannot be the entire story. So why am I saying that? Well, I'm saying this because let's look at we generally associate panic with household behavior, right? Because the households, they're not as informed, they lack the specialized knowledge about trading in financial markets, so they have a higher tendency to exhibit panic behavior. So the professional investors are more immune to this type of panic-driven trades. So if that is the case, then we would expect that the assets that are traded more with professional traders, right, they don't exhibit this kind of volatility. Is it the case? No. Perfect example for this will be the fixed income market, for instance. In the fixed income market, the direct participation by households are almost zero. But despite that, we have seen huge turbulence. So then the question becomes, if the panic is not the entire story, then how do we think about it? What is really going on? So actually, we have seen these kind of things happening during the 2008 crisis. And because of that, there has been a humongous amount of research going into this in the past 10 years and trying to understand these effects. And I myself, focusing on financial stability, have also contributed to these research efforts over the past years. And long story short, what we have uncovered as researchers is that there are important structural vulnerabilities so embedded in financial markets, which propagates the effects of these initial fundamental shocks, such as COVID, and then spreads to all asset classes, including even the very safe ones. So you might be wondering, what exactly those structural vulnerabilities are, right? You want to know what they are so that we can be better prepared for the next crisis, perhaps. Well, this can be a long discussion, and you can have a whole course on it. And we are teaching this kind of stuff at the SBS. Dimitri is teaching one, and I'm teaching also another one. But just a long story short, and just to give a flavor of what sort of mechanisms are available, what kind of mechanism basically generate these propagation mechanisms, is, one thing that I can easily explain is this concept of use of leverage or margin trading. So what happens is that, during normal times, a lot of traders, a lot of investors actually, this not only for financial markets more broadly, this also applies to real estate market. If you don't have enough capital, if you want to make some investment, buy a stock, buy a bond, or buy a house, you borrow some capital from a lender, your broker or your bank. So what happens during bad times is that when there's a sudden drop in market prices, then the total value of your portfolio, of your assets, are going down, which then mechanically increases your leverage ratio. So then what does it all mean in simple terms? It basically means that when the leverage ratio shoot up, you're going to get a call from your broker or your lender, and he's going to tell you, well, I lend you all that amount of money, but now the value of your assets are going down. I'm never feeling as comfortable lending you that much amount of money. So can you actually put out more cash into your account? So you're going to get a margin call. Then what is the problem? Well, this is a problem because most of these customers, right, investors who borrow in the first place, they're borrowing because they don't have enough cash. So when they get this margin call, it is very unlikely that they have some free cash lying around so they can easily update. So when they're unable to fulfill, right, these margin calls, then what happens is that they have started liquidating. They have no choice but start liquidating their portfolios. And the portfolios may include both a combination of safe assets and unsafe assets and more risky assets. So there's going to be large sell-offs in all of these kind of different type of assets. And when there's a lot of selling, right, like what's happening right now, but not enough appetite in the market to purchase, then basically a lot of assets, including the safe ones, are going to end up selling at fire sale prices. So this mechanism, for us, basically can propagate and the impact of the initial shock. And in a paper of mine with a co-author, we showed that actually this mechanism is a lot more important to explain this market volatility than explanations based on panic.
Okay, so we'll hold that for a minute. I'm pleased to say we have people joining us from Brazil, from Australia, from Germany, the United Arab Emirates, Scotland, England, Lebanon. We've got someone from Tunisia, Ireland, Malaysia, USA. So we've got an amazing global audience with us. And there's a couple of questions coming in, which I'll come back to in a minute to start with you, Alan. But I want to turn now to Dimitri, because Dimitri, you've worked with many central banks on financial stability, looking very much at the role of central banks. I know that you have a few slides you want to share with us. Perhaps you can start by just giving us a sense of how you see the current situation.
Thank you very much, Kathy, and thank you for organizing this. Let me see how we will use the new technology in this brave new world. I think.
So that's fine. I think your slides are up.
Okay, excellent. So basically, I would like to start by having the stylized facts in place, since this crisis is something that, like no other, something that we have not seen in the past, since there was a combined supply shock that created a demand shock that eventually potentially may create a banking and a financial crisis. And moreover, this may have very serious geopolitical consequences. In fact, nowadays, I just realized that there are massive wildfires that roll through the Chernobyl exclusion zone. So basically, you have all the ingredients of the perfect storm. The main thing of this crisis, if you see in the right-hand side of the panel, there is a huge increase of initial jobless claims, which is more than any time in the recorded history, including the Great Depression. And actually, today we know that these jobless claims have increased, at least in the US, to the number of 16 million. Then, moreover, if you disaggregate this kind of increase in jobless applications, we see that the price is paid this time by the middle skilled and the low skilled employees, as we can again see in the right-hand side, where we have basically 1.26 of low-skilled employees unemployed and 151 middle-skilled. So this may impregnate subsequently further polarization, political polarization, and open the gates to populism and various other extremist political movements. With respect to the GDP, one can see that the advanced countries, this quarter-to-year normalization of a GDP, forecast that the GDP could fall by huge amounts particularly in the advanced countries that are basically the blue bars that are substantially bigger than the ones of the developing countries. Moreover, we can see the particular impact, economic impact of this crisis is in areas like hotels, restaurants, air travel, and primarily retail and wholesale trade. And that later on, I will argue, that will contribute and precipitate widening the gap between the North and the South in Europe. However, the distinctive characteristic of this crisis is, besides having a real impact and a real economic effect, it also has higher aggregate default rate forecasts. And here you see in the US speculative grade default rates have increased substantially, and they have, to some extent, at least temporarily under the pessimistic scenario, overtaken the great financial crisis. And that's why I argued in the beginning that this is a crisis like no other that we have seen in the recent past. However, let's try to see how we can respond to this crisis. Can we do this by monetary policy? As we can see here, the policy rates across the world, we cannot push on a string anymore. That's the famous sentence by Keynes, indicating that we have a liquidity trap and ample liquidity, so that basically monetary policy is not enough this time. And this, coupled with the fact that we have a massive flight to quality from the emerging markets back to the advanced economies, and we see here what's happening on January 21, 2020, with this crisis, we see what happened. We have a financial run on emerging markets that dwarfs the financial crisis of 2008. So that basically allows us to ask our question whether this will point to the end of the globalization as we know it so far. However, the big elephant in the room is the government debt, and the government and the public debt has increased and will increase even more. Please recall that the government debt before the global financial crisis 2008 was 65%, it went up to the 90%, then with the austerity, with the brutal austerity on the South, it went back to 84%. Now, if we have a 10% year contraction, GDP contraction, that may imply, given the figures that you see on this picture, that the eurozone average public debt, government debt, would go over 100%. And in particular in Italy, 158, France over 130, Portugal 144, whereas in the Netherlands and Germany will remain below 100 in the vicinity of 80%. And you realize that this may very easily enhance the North and South divide. And you realize that if you see the main impact that was on tourism and retail, that the Southern Europe depends very much so on the economic areas that have been impacted the most. Now, monetary policy, as we said, you can push on a string that much. We need fiscal policy. But if you see the fiscal policy headway that exists, we see basically that again, the South is like lambs for slaughter, given the limited fiscal space that they have available after the global financial crisis and the eurozone debt crisis and the infamous memoranda of austerity that were implemented in the entire South and that decimated their corresponding economies. And this basically is food for thought. If you see the per capita GDP between the main countries, Germany, Italy, Spain, Portugal, and Greece, as an example, you see the widening gap, and pretty much that indicates that if the Eurozone doesn't act yesterday, that will be the genesis of many, many problems. And as pointers for our discussion, we talked about the monetary policy. We need money, finance, fiscal stimulus. Then we need to have, since we have balance sheets interdependence, and we are in view of a systemic bankruptcy, we need softening of defense regulation and particular restructuring on NPLs that are looming bigger and bigger after the lockdowns and the half lockdowns that will come subsequently. We need sovereign debt standstills. In fact, we need debt moratoria, particularly for emerging countries. In fact, the African countries that are always ailing, they're in much worse shape after the virus economic lockdown. So we need that. And all of these things basically are summarized to a beautiful proposal by Draghi, Mario Draghi, the former ECB governor, who talks about higher public debt and cancellation and write-offs of private and corporate debt in order to jumpstart and overhaul the economy. And as far as the widening north and south divide, some kind of sovereign debt mutualization is warranted in order to avoid the untimely dissolution of the eurozone. Thank you very much.
Dimitri, thank you. So, in fact, we do have a question coming in from one of our audience about that and about globalization. So from Yaman, saying The Economist has predicted a rise in corporate concentration and an accelerated sort of deglobalization. So perhaps, Dimitri, you could take that first, and then others, Alan and Bige, chip in as you would like to. So how much is this going to contribute to deglobalization? Where is the whole concept of globalization going to go after this?
Well, as we saw, and I have to share one more interesting transparency slide. You see here the massive, the unprecedented emerging market outflows. So you see again the right-hand side what happens with emerging markets debt excluding China, emerging market equity excluding China. Basically, this figure indicates and points to the direction that people are flying back to their national borders. And if this is accompanied by tariffs, quotas, and further unwelcome trade wars among the main players of the international economic scene, definitely coupled with the migration flows that are not getting any better, and they are not managed in an efficient and humanistic way, that might impregnate further problems and further tendencies towards isolationism, populism, and extreme nationalism.
Okay, thank you. So we're also getting, along with the questions about globalization, quite a lot of questions about the market and market volatility. One from Ronnie in the UK saying, is it the right time to invest? And are there some bargains to be found now? And on a sort of broader point, Daniela, who is one of our Masters in Major Program Management graduates. So welcome, Daniela, nice to have you with us. Saying, why has it been such a shock to the markets if global pandemics have long been predicted as a risk? And just another, not not related to this directly, but and might be perhaps for Alan or Dimitri to answer. Interest rates. What strategies can we use to deal with interest rates? So that's slightly different, but perhaps you could address the market issue, Bige.
Yeah, definitely. So, well, I guess I should first begin with saying that don't take investment advice from academics. So they might have a full knowledge about the research that have been done on these things, but at the end of the day, they're not practitioners. But just my humble view, just a couple of suggestions, and to help people better understand the best way to approach in surviving this crisis is, first of all, yes, it is true that, I mean, this is actually going back to a little bit what Alan said in the very beginning. So there's a fundamental shock, right? And because of that, the company fundamental values are being adjusted and therefore it's being priced. But on top of that, there's also a liquidity crisis that is going on. So what does liquidity crisis mean, and what does it imply in terms of our investment strategies? What the liquidity crisis basically means is that during a liquidity crisis, the asset values don't only reflect the fundamental values. In fact, the link to the fundamental values are weakened. But what the asset values reflect is basically the liquidity conditions. what if all of this means is that during a liquidity crisis, the certain assets, like as I mentioned before, the safe assets, they may even lose significant amount of value during the turmoil times, but that doesn't mean that those assets actually have weak fundamentals. So from an investment point of view, then these kind of assets might be actually a good opportunity for investment. I will suggest that, the investors look into safe assets, the companies with strong fundamentals, and if they want to invest. And one word of caution that I want to emphasize it here, which I think is very important, is that there's an asset class of corporate debt, which is like particularly vulnerable. And I guess they want to be particularly careful if they want to start investing across the board, including both stocks and corporate bonds. So this has been actually not a new phenomenon, but this was already discussed prior to the virus shock, that due to the extremely loose monetary policy that the Fed has been pursuing in the aftermath of the 2008 crisis, the interest rate have been extremely low. And as a consequence of that, we had the corporate debt has risen in significant amounts, but more importantly, the quality of corporate debt have gone down substantially. So this is called the zombie credit. So nowadays there's a lot of zombie, like really low quality corporate debt floating around. And those type of asset classes, I think we haven't seen the defaults happening or the downgrades happening in these asset classes yet, but that doesn't mean that they're safe. So I will caution against the corporate debt, but focus on the safe assets.
Okay, thank you. So, gentlemen, I don't know if either of you would like to comment on interest rates and what, if anything, what kind of role interest rates could play in dealing with this. Alan.
Well, I think Dimitri's pretty much nailed this. Interest rates are already awfully low. We can't push on a piece of string and make them much lower. And we probably have to look for solutions in other policy instruments, because monetary policy can only take us so far. That's not to say that policy can't achieve anything, monetary policy. The problems that Big A has been talking about relating to lack of liquidity can, to some extent, I'm sure Dimitri has more to say about this, but can to some extent be addressed by central banks buying safe assets, which happened in 2008. And recently the Bank of England massively expanded its capacity to engage in straightforward monetary financing, which in normal times is viewed as a danger signal, but right now is probably necessary and desirable to stop, to sort of temper the type of liquidity shock Big A is talking about. So that's a kind of monetary policy, but it's not really a reduction in interest rates because they have a lower bound. Dimitri probably has more on that.
Dimitri, do you want to?
The only good thing about the low interest rates is that the interest rates would be lower, perhaps, than GDP, which is the GDP growth. Therefore, the debt sustainability issue may not be exacerbated. But nevertheless, given that we are very, very near the zero lower bound, debt monetization at zero interest rate has no effect up to a first order. And basically, if you have two identical assets paying zero, then doesn't quite cut it. Thereby, that means that you need money finance fiscal stimulus, the way that the US, the Federal Reserve has done it, the way that the Bank of England is doing, that directly lends disaster relief to the government, because, mind you, as we said, the fiscal policy will play a very important role, and it will play a very important role because it will expand beyond the aggregate demand management, but also to take care of the health emergency and to do disaster relief in one shape and form, and therefore to work the printer, so to speak, the printing press, will be something inevitable and something necessary at this point in time, as we have pushed the string. We cannot push the string on pure monetary policy. Thereby, you need combined fiscal monetary as well as regulatory policy, which will unleash more capital that is standing still in the bank's balance sheet. Because we forgot to mention that the banks, in the onset of this crisis, are more well funded than they were before the global financial crisis. Therefore, as the situation has already happened in the ECB, by lowering de facto the capital requirements, more credit may flow to businesses and small and medium-sized enterprises. However, having said all of these things, we have to be very, very cognizant of the fact that now, since the societies, in a way, bailed banks out during the global financial crisis, we have to create the right incentives so this credit and this liquidity will go to resuscitate and sustain the viability and sustainability of small and medium-sized enterprises, as well as firms to reduce potential unemployment surges.
Okay, so I'd like to go back to this concept of the V-shaped recovery. Are we going to have a V-shaped recovery, a W-shaped recovery, a U-shaped recovery? And there's a lot of discussion about this. You mentioned it at the very beginning, Alan, in your introduction. Prasanna from the UK has said, how can we predict this? What shape do we think the recovery, when it comes, is likely to be? And perhaps you can explain about this idea of the very quick bounce back versus something much, much slower.
I can try. So the idea behind the V-shaped recovery is that I talked about hibernating the economy. Imagine we all go to sleep for 3 months. Nothing gets produced. We wake up, we go to work, we took off exactly where we left off, and the economy bounces right back to where it started. That would be a perfect V-shaped recovery, and that's the best we could possibly hope for. I'm not really in the business of predictions. I think we'd be lucky to get a perfect V-shaped recovery for a variety of reasons. One is economic. When people are away from their workplaces, their human capital erodes, they become less skilled, it becomes harder for them to accomplish things, relationships atrophy, and it just becomes harder to do business. There will be some period in which, even if we simply woke up and started again, it would take a while to get back to work. And there's also a question of how rapidly one can unwind the sort of lockdown that we've been in for the last month. We won't suddenly wake up and go back to work. People will emerge slowly, and some people may be quite unwilling to emerge from lockdown for fear of the consequences. So hope for a V-shaped recovery, but I suspect it will be a little smoother coming out.
Okay. And
I'd like to add a couple of things to that, if I may. I get this question a lot. I think a lot of market participants, right, are now interested in finding out what the exit is going to look like, or put it differently, the recovery. And so far, I have seen three hypotheses, like the U shape, which is like sudden drop, sudden recovery, and then the V shape, like gradual decline and gradual improvement, and then the L shape, which is like a free fall and then permanent damage. So no recovery. So I think it's important to think about each of these carefully. And I've seen also a lot of academics making predictions about it. I agree with Ellen that I think we should be always a little bit careful making predictions. It's because what's going to happen, basically, the recovery phase pretty much depends on what the government is going to do going forward. And this is something we don't fully know right now. But at least based on the information available as of today, my humble opinion is that I differ a little bit actually on this from many academics. I think many academics are expecting a full recovery in the form of a U shape, perhaps a little bit optimistic. I actually don't expect a full recovery. I don't intend to be the Mrs. Doom from Oxford, but I feel like I had to, express my honest opinion about it. The reason why I don't expect a full recovery, and there's going to definitely a recovery. I want to emphasize this, so people don't panic. But I don't expect to be complete recovery. The reason for this is that I think this is more related to we need to ask ourselves, so what was the state of the economy, before the virus? So before the virus, there was already actually a lot of discussions about the market, the economy being overheated. And this is, again, going back to the monetary policy issue, because of the interest rate being extremely low, the market has been overheated. And a lot of people actually, including myself, academics, market commentators, and the regulatory bodies believe that the market was overpriced and a correction was doomed to happen. And if you ask me what is happening right now, the decline in the prices is not only reflecting a correction, is not only reflecting the adjustment due to the COVID, but also this long-awaited correction that was expected to happen. So this is one. So therefore, I don't expect a full recovery. And second, on the speed of recovery, I think this is a lot of people are curious about. I mean, first of all, I think the speed of the recovery is pretty much going to be determined by the health advancements, right? The medical innovations that we're all hoping for. So testing, treatments, and vaccines. And it seems like the vaccines, they take a very long time, unfortunately, and the treatment perhaps a little bit faster. And maybe the antibody testing, right? It seems like the biggest hopes is at least the antibody testing can be available sooner, so that at least people who had the immunity can get back to work. But there's a great deal of uncertainty with respect to these things. And then the second point I'd like to make, which is more about the economics, which is my area, I think the speed of recovery is going to pretty much depend on whether the job losses can be avoided or not. So there's a large literature in the labor economics is that there's a huge, extensive frictions in labor markets. Finding the optimal combination of matching between the employee and the employer can take a long time and also a lot of effort. I think if the job losses can be prevented, when these medical innovations take place, then the firms can go back to production levels, what it was close to what it was before, much faster than in the case of when the job losses are unfortunately are when they're not being prevented. So with respect to that, I think it might be useful to contrast the policies in US versus Europe. In Europe, as part of the stimulus package, right, the European governments have basically subsidizing now the firms with respect to their labor bill. Well, they say we're going to pay, say, about 80% of your labor bill, so please do not lay off any employees. I think, in my view, this is a much better approach, and from an economic point of view, and it's going to be much more efficient than for instance, the US approach, in which they provide unemployment insurance to the employees who have lost their jobs. It's definitely useful to have these insurance plans, definitely, but this doesn't prevent the firm from laying off the employees in the first place, right? But also, if anything, perhaps it might be increasing the incentives for the firm to lay off, because now they know that these people actually have a safety net. So I think, something probably one should think about it more carefully. I think keeping the existing links between the employees and the employers, in my view, is very critical. That's going to determine the speed of the recovery.
Okay, thank you. So we've got some more questions coming in on markets. In fact, we've got a lot of questions coming in, so we may have to keep the answers reasonably brief. So shifting slightly, one question from Stuart was saying that, Alan, you were asserting that the banks are in good shape compared to the crisis of 2008, and one view is that was due to the increased scrutiny and increased regulation. So what is the panel's view on the more opaque private investment industry, firms that have been relying more and more on non-banking sector, private equity, pension funds? How fragile are these investments? And what is the risk to the wider market from that fragility? Who would like to go first?
I'll make a very brief remark. I think it's true that banks are in a better shape than they were in 2009, although I'm sure they're not perfect. That's partly due to increased scrutiny. It's partly due to regulation that forced them to maintain higher capital buffers and more liquidity buffers. It's also because banks have been prevented from doing some of the business they were previously engaged in involving proprietary trading. And the consequence of that is that quite a lot of activity, as we've just heard, has been shifted out of the banking sector into the non-banking sector, which has roughly, near as damn it, doubled in size since 2008. So it's the fat end of $180 trillion now. It was about $100 trillion in 2008. And that's not particularly regulated, not to the same extent. Whether that has systemic implications is less clear, because that sector is less levered. Losses are drop straight in the laps of investors rather than maintained at the bank. But we should be worried because those investment funds very often allow people to extract funds on demand. And if they suddenly stop lending, then we experience a credit crunch, for which I think we have fewer policy tools available. Sorry, Dimitri, you were about to say something.
Dimitri.
Yes, I would just want to show another stylized fact about the global non-financial corporate debt. We realized that after the global financial crisis and a short decrease, then it has soared and has gone through the roof. You realize that in the mature markets is almost 90%, and in the 30 emerging markets is 90%. That means, given the fact that the banks are well capitalized, the problem is not coming from the banks this time, but it's coming from the corporate sector. And the corporate debt is what will break or make the situation. And the real question about banks is nothing more whether they will pay their dues back by channeling this immense and humongous liquidity in steroids that has been given to them back to the real economy, back to the small and medium-sized firms to resuscitate, to reignite, and to jumpstart the ailing, and if you will, the economy that's like a car that has stopped for already too long. And before it becomes way too long, we should jumpstart this whole economic structure, because, as I said in the beginning, it's very easy to close down a shop, but very difficult to open it up again.
So a question related to that, really, which, of course, commentators and experts and all of us are asking is, well, when's the deadline by which you have to get things going again? Otherwise, there will be such a deep recession that it will be very, very difficult to get out of. So there's this dilemma about when you actually try and lift restrictions, when you have to make a decision about saying now the economy has to open up again, otherwise it will just be too bad. Dimitri, I think you wanted to come in there.
I mean, it's a question that has been asked continuously in many of these panels. I think economists should not comment on that. There is not a trade-off between human life and the economy. This is a question that should be addressed and answered strictly by scientists. Okay.
So going back to the markets, Bige, we've had quite a few questions in about fund managers and different asset classes. One from Boom Sim O from the UK, who is an associate at BlackRock Capital. How would you describe the level of margin trading currently? And do you see the pace of margin calls accelerating in the future? And perhaps if you can keep that to sort of layman's terms for those who are not in the industry, that would be great. And then do you think, Taha from the UK, what kind of, we're seeing asset destruction and deterioration. So where will the flight to safety be in terms of asset class or in terms of geography?
So a lot of questions there. Again, investment advice. Well, in terms of leverage, I think there were a lot of leverage. I think prior to the market was highly leveraged. This is all because the rates were very low, so the credit was cheap. When the capital is cheap, of course, then a lot of investors will use a lot of leverage. So we were already highly leveraged. Well, except with the exception of banks, perhaps, is because after the 2008 crisis, they put a lot more stronger, stringent capital requirements on them. So which is great because now the banks are safe, as Ellen was saying before. So this time they're not the root cause of the problem, but potentially they're the solution. But for the rest of the market, I would say probably it's like highly leveraged. And in terms of the deleveraging cycles, I think we have seen some already. But again, I don't want to sound pessimistic, but we may see more, I think, coming. And this one I want to link back to the Dimitri's point on the corporate debt. It's going to be like a repetition, but this is very important. So the corporate debt in the US and also in other developed countries like in the UK and other European countries, this has been a major issue. And actually over the past 5 years, a lot of people have been talking about the potential problems arising from the corporate debt. This market is incredibly fragile. So there's a low quality and it's in huge amounts. So what are the next deleveraging spirals that this may trigger? If this fiscal stimulus packages turns out not to be entirely sufficient, if you start seeing a lot of defaults or a lot of these zombie credit, or like media, or like say triple B sort of, some okay, I don't want to get too technical. Some of the credit we thought there was more high quality, but if you find out actually if they're downgraded, if you find out that their quality is much lower, so if they're downgraded, these kind of events can trigger a huge amount of sell-offs. And so they're meaning that this may further destabilize the markets. I think this is relatively early stage. We haven't seen too much of that yet, but doesn't mean that it's not going to happen. I think we need to be a little bit careful with that. And then you might be a related question. You might be wondering like which market participants has the largest amount of exposure to this. So what does it mean for me as an investor? So one thing that I would like to highlight here is that, so the mutual funds, for instance, like the largest players who have exposure to the corporate debt is generally like insurance companies and so on and so forth. But there's one player, which is mutual funds. They also have huge amount of exposure to the corporate debt market. And why am I bringing this up? Because I'm bringing this up because, as some of you may know, the mutual funds is kind of the investment vehicle for the large fraction, about 80% of households for retirement savings. So households generally don't have direct ownership, they don't have direct participation to the corporate debt market, but that doesn't mean that they're immune. Through their indirect ownership in mutual funds, they can may experience some losses in the next coming months.
Okay, so and to the broader picture, we have several questions about developing economies and the effect on developing economies. From Ashish saying, is helicopter funding the last resort for developing countries? And some other questions around how developing countries are going to be able to respond to the crisis compared to developed countries. So I wonder, perhaps Dimitri, you might like to start with that. And then we could perhaps talk a little bit as well around the different role of the state and the firm as this crisis unfolds. So, Dimitri.
Well, the developing economies, first of all, we have to, given the interest rates, the low interest rate, the zero lower bounds, currency depreciations and currency exchange rate management may not help now. Once again, the point for developing economies, the highly indebted poor economies in Africa is their debt sustainability. Already the IMF has introduced standstill, SDRs, and various other aiding measures to help aid and enable developing economies to pay back their loans and avoid default. So in effect, they're trying to avoid what's happening now in Argentina or what happened last month in Lebanon. However, the core of the question is what's going to happen to globalization. Because as long as we have trade wars, quotas, and various trade restrictions in the shape and form of capital controls or tariffs and quotas, then the factor price equalization will cease to exist, and then we'll have divergences and we'll go back to a more isolationist world whereby the mutually beneficial benefits of international trade, international investments will cease to be reaped by the international economic community. Therefore, it is key to retain open borders, open trade, and not to raise walls, economic walls, either for people or for capital or for labor.
Okay. Question from Mustafa Abbas, who's one of our executive MBA students here in the UK. Looking really at the political landscape, both in Europe and separately in the Americas, inequality is already a big issue. What will this crisis do to exacerbate that? And how is capitalism going to be redefined by the crisis that we're now seeing unfold? Alan, I think I have to go to you because you haven't said anything in the last few minutes. So regardless of whether it's your subject or not, this is for you.
It sort of is.
The future of capitalism. What could be easier to answer?
5 minutes. Well, I think inequality is probably not. Okay, there are 2 points to make. The first is that a crisis like this, we already have observed, hits the poorest hardest. They live in some countries in relatively cramped conditions on top of each other, so that a virus spreads rapidly. And in every country, the poorest are very often the people who can't work from home, who are obliged to go and face other people. And the evidence so far is that the poorest people are hit the most. So there is an increasing degree of inequality anyway. In terms of what this means for the future of capitalism, it's interesting and tragic that this has happened in the wake of statements by organizations like the Business Roundtable saying that businesses should account for more than just the interests of shareholders. They should worry about their employees and about the communities they operate in. And that seems to be something that's got some traction at the moment, in that people are worrying about executive pay at a time like this. They're worrying about the distribution of resources. They're worrying about the distribution of the pain, the economic pain that comes with the health crisis. Whether this will have any sort of long-term effect on the way that we run capitalist economies, I don't know, but I suspect it will result in more debate and discussion, and that can only be a good thing.
And in terms of corporate governance, how do you see companies emerging from this? As you know, the shape of firms is going to change, their ability to and their desire to operate in a globalized world is going to change, as Dimitri has pointed out. You teach corporate governance and business ethics. So what are the issues you think that firms are going to have to address, first of all, as they start to come out of this crisis?
Well, the issues that Dimitri's already talked about are absolutely critical in terms of the developing world. Trade wars harm the poorest, and the danger of a crisis like this is that it generates the sort of nationalism that causes trade wars, and that harms the poorest. I'm not sure that's a corporate governance question, but it's certainly an ethical question. In terms of corporate governance questions, I guess corporations are going to be asked difficult questions about how ready they were to support their employees when something like this happened. And again, questions about the extent to which labor has some sort of say in the way that the organization works are going to become increasingly salient. How that will work out remains to be seen, but I think it's a conversation that we're going to have more and more, and firms are going to have to deliberate more and more carefully about this sort of thing. And this isn't a particularly radical perspective anymore. You see it on the New York Times deal book yesterday with a US judge making roughly the same point. There are questions here about precisely to whom managers owe fiduciary responsibilities.
Okay, well, I think that's a thoughtful and good way to end this conversation. I'd like to thank all three of you and to everyone who joined us from around the world. I know, Dimitri, that a couple of people on the Q&A section have asked if you could share your slides, which I'm sure you'll be very happy to do. So we will have a way of doing that for those who've been with us. And this is recorded, so you're welcome to watch again through our website and through LinkedIn. That is all we have time for. It's been an incredibly wide-ranging and detailed discussion, and I'm delighted that all of you as my colleagues were able to join and share your expertise and your thoughts. on what is such a momentous time for all of us. I know that the next conversation we have will be looking at scenarios and scenario planning with my colleague Trudy Lang, and that's going to be on Thursday, I understand. So I hope that some of you will be able to join us then. But in the meantime, in what is a very difficult time for so many of us around the world, I'd like to say thank you for joining us on behalf of Oxford Saïd and the University of Oxford, and to wish you and your families well. Thank you.
Thank you very much.
Thank you.
I think that.